Yeah, so our fee structure is a very disruptive one in the industry because no one else does it this way.
Yeah.
And when we started third party, we said if we were not managing our own assets, how would we want someone to manage the assets we own, right?
Yes.
And so we looked at it from an actual ownership perspective, and we came up with the idea that, you know, we should only be successful as the success of the property garners itself to be successful.
Welcome, my fellow flow masters, to another episode of the Cash Flow Authority podcast. I'm your host, Chris Jansen, founder of the Flow Authority, and this show is for high-performing professionals who did everything right. You've got the degree, the career, you've got the income, but you just feel like there's another level waiting. So here we explore how real estate can become that next challenge worth building so you can take ownership of your future and create a life by design. So to help us out with that today, we're joined by a special guest, Mr. Teddy Abdelmalek. And Teddy is a Senior Vice President of Business Development at HH Redstone, where he leads national expansion across student housing, multifamily, and affordable housing. He has over 25 years of experience, previously served as National Director of Business Development at Campus Life and Style, and helping scale a leading third-party management platform. So lots of great experience we can explore with Teddy today. So happy to have you, Teddy. Welcome to the
Yeah.
show.
Thank you. Thank you for having me, Chris.
Yeah, man, I don't even know where to start. There's so much experience and diversity there. Maybe just walk us through, your journey over the past 25 years and how that experience has kind of evolved.
Yeah, no one says that they want to go to college for real estate or property management, if you will. No one says that. So I definitely got brought into the real estate platform accidentally and really into student housing accidentally. I was, an RA at the University of Missouri, Kansas City, managing, basically the operations side of the on campus housing department. And, really just fell in love with operations, how the building kind of played into the student experience and how that experience really cultivated the minds of the people that were staying with us, right? And it was like this niche cohort of students living on campus. They had a pretty small segment of their student population living on campus at the time. Now it's grown, but I got started in that aspect of it, and then as they started to expand with private-public partnerships, with private developers, and kind of grow their housing footprint, I was, kind of leading the charge in regards to, the liaison between the developer and the university, and really getting into privatized student housing in full force. So
Nice. And
it was really great.
are you like national? Are you focused on just one market, or what does that look like?
Yeah, currently with HH Redstone, we own and manage assets across the United States, everything from West Coast to East Coast. I'm based in Kansas City, so I'm in the center of the country. I can go anywhere pretty quickly, but our headquarters is in Silver Spring, Maryland for the company.
Okay. And so, so are you only managing your stuff, like your stuff that you own, or do you manage other investors' properties in these spaces too?
Yeah, until recently, we were managing and owning our own assets. And then, like I said, just recently, we started third party property management, which really allowed us to give our employees just more opportunities to grow and cultivate their professional growth, which is kind of one of the reasons why we decided to do that. It's really hard to buy assets that are actually correctly purchased, right? That they're actually cash flowing.
Yeah.
You're not just buying assets for the sake of, losing money.
Adding
But it
doors.
gave our employees opportunities to grow professionally. And then there's the second aspect to it, that it allows us to kind of grow our acquisitions pipeline as well, because it allows us to be intimately involved on those assets than previously not involved, right? So if you're intimately involved and an owner has never seen a day over a certain occupancy, and when we get it there to the promised land, their fingers really on the trigger to release that property because it's never been that successful,
Yeah.
right? And so they'd
Right.
rather just, cut their losses and be done. So we become a natural buyer as a result of that as well. So,
Oh, okay. Okay. Nice. Yeah, I mean, we're always looking for underperforming properties, which, if you're new to this, sounds weird, right? It's like, why would you buy something that's not doing what you want it to do? But, really that, especially multifamily and how you value the properties, that if it's underperforming, you can get it at a discount, but you got to know what you're doing, be able to, get the occupancy where you want it and all the stuff you're talking about, right?
yeah, we're very opportunistic. We look at foreclosed, we look at auction deals. We're not going to be the top priced offer by any means, but really the bread and butter associated with our platform is that operationally there's the value add, right? Not necessarily is it cosmetically ruined, or not that
Yes.
we can't do that. We could do that as well, but really at the end of the day it's managed incorrectly, which creates a deficit from the ability for it to cash flow. So
So yeah, so that's interesting. Like where, I mean, we see this a lot, looking at deals, but where does the issue lie? Like where do management companies fail that you come in and fix it? Because everybody says that, like, oh, this property's
oh yeah,
underperforming, the rent should be double. Well, why do you think it's like then? I mean, Grant Cardone's real estate club, so he always asks, well, why do you think you can do better than them? Why are you
yeah,
so magical? That you can all of a sudden just double the rents, and over two
yeah.
years or whatever. Crazy.
Well, I mean, and I'll share with you the secret sauce, right? The secret sauce at the end of the day is how you treat your residents, right? The same way that you treat your capital partners and the owner of the asset, if you're third party managing it, is the same way you should be treating the residents that you're serving on a tenant basis, right? So it's as simple, Chris, as knowing your name, right? Knowing your pet's name, knowing everything about you as a resident, and being able to implement that into the relationship that we have as tenant and landlord. But even really at that nomenclature of me being the landlord and you being the tenant, I would argue that's a very archaic, and it in of itself, the nomenclature speaks to the hierarchy between how we don't treat tenants as if they are the owners of the asset. Because really at the end of the day, the investment value is built around the tenant base. If your tenants love you and they respect your property, you're going to be able to ask more for rent, and you're going to have a better retention value associated with the folks that stay with you, right?
Right,
Really, at
right,
the end of the day. And the whole idea is how I make you feel when you live at my property. There's an emotional connection that's created with all the products and all of the services that, we interact with on a daily basis as humans, right? I drink, Coca-Cola versus Pepsi because, I feel a certain way about that brand, right? Or I interacted with someone from Coca-Cola on that aspect, or, I shop at Target versus Walmart or vice versa, right? It's because of the environment that has been set by how you relate to that brand and that product, right? So we try to incorporate that on a very micro scale, at our assets as well.
uh-huh.
And like I said, by knowing their name, knowing their pets, knowing their family members, knowing if they have, a final exam coming up, or if there's something that's going on in their life and we're able to, maybe they had a death in the family and we send flowers to their residents. I mean, that's huge, right? It means we're connected to the resident on more than just you pay rent and I collect rent,
Yeah.
right? And it's more than maintenance work orders, right? And so the philosophy that we've incorporated is, and the phrase that I'll leave your listeners with is, treat your residents as if they are the CEOs of your property.
Hmm.
And that whole mindset shifts, right? If you were the owner and I was managing the asset for you, and you come and you visit the property, I'm probably going to ensure that the property is in top tip shape when Chris comes to visit, right? I'm going to make sure everything looks clean. I'm going to make sure, everyone's dressed appropriately because you as the owner are visiting the asset, right? And so use that same sort of mythology associated with the residents who are living at your property every single day, right? And this could be affected whether or not it's single family rentals, multifamily, student, affordable, mixed use, you use the same aspect by treating your tenants as they are part of the capital stack that you're serving. And everything else transcends into that. Reputation starts being better, your curb appeal, obviously ends up being a lot better because your owners are on your property every single day. And so that sort of mindset is something that's obviously easy to say, but hard to implement from an investment standpoint to get everyone on your team on the same page. Because really, at the end of the day, they see themselves as the landlord and, striking down rules and regulations and policies. And there are certain people that may be on your team that enjoy being the rule enforcer, right? Whether that be the GM or someone on the maintenance side, they want to regulate and enforce policy.
Yeah.
But I would argue that comes in line with how you treat your residents.
Okay. Definitely.
Isn't that interesting?
Well, yeah, it is. I mean, it's like treat others, how you want to be treated. And when I first got into investing, I took a whole class called Your Investor Identity, and I've kind of replicated that now in my training as well. And part of what the biggest question in that class was, who do you want to serve? Mm-hmm. And even when I took that class, I'm like, what are you talking about, dude? I'm not serving anybody. I'm charging massive rents. I'm like, who do you mean serving? Who am I serving? I'm hiring a management company to do this for me. I'm just going to collect a paycheck. I ain't serving nobody, right? So that made me rethink that. But the way you explained it, kind of reinforces that even deeper.
Correct.
But so if people are hiring you as a property manager, there's all sorts of fee structures, but they're all kind of based around, well, what's your percentage of the rent? Is it 8 or 10 or 12% of the rent? Even, and some of them, that's all they charge. Some of them, they have all these ancillary nickel and dime fees and all this and that. So if you guys are on it and really that close with the tenants, how does that impact the fees cost, and like, how do you do your fee structure?
Yeah, so our fee structure is a very disruptive one in the industry because no one else does it this way.
Yeah.
And when we started third party, we said, if we were not managing our own assets, how would we want someone to manage the assets we own, yes, right? And so we looked at it from an actual ownership perspective, and we came up with the idea that, we should only be successful as the success of the property garners itself to be successful. Okay. So, all too often these management partners are making money regardless if the property is actually being ran well. I can get you to 100% and you're going to pay on revenue, right? 10% or whatever the percentage is. Yeah. But if I overspend my expenses, then, essentially your NOI, your net operating income could be zero, but you're still paying out your management partner like everything was successful, right? And that doesn't resonate well with us when we're talking about, stewardship and what that actually means running the property successfully. So, what we've done that's really disruptive in the multifamily and student housing space is that we will charge a base management fee that starts the machine engine, the management engine, if you will, right? And then when we meet or exceed the budgeted NOI that we both agree on, then you would pay me what you traditionally would have paid a management partner. And that idea is that we are aligned with the owner in regards to the attention and the focus that we're giving. We're only going to get paid when the property is successful. And, it all transcends very similar to your capital stack. When you have LP partners and other equity partners that are involved in your deal, they're only getting paid when the property is being successful. So why should your management partner be any different to that capital stack, right? And so what it does is it prevents operators from just being a warm body at your property. They're actually putting their money where their mouth is. They're saying, I will perform. For the love of God, I'm going to perform or I'm not going to get paid, right? Yeah. Or I'm going to get paid whatever it is just to start my management machine, which is there's no profit at all in that regard. So as an owner, you feel confident that I'm on your team. I am working as hard as I can to drive results. And that's really the only indication that will really produce success at the end of the day is, were you successful and where are the results associated with it?
Yeah.
So,
Okay. So that, yeah, it's different. I like it. I mean,
yeah.
especially obviously being focused on NOI. So NOI, net operating income. So when you're looking at that, is that month by month, or is that, because obviously some months you have no maintenance, and it's like, oh wow, look at the NOI, it's amazing.
Yeah.
And then the next month you get slapped with all the maintenance, and okay, I won't take my fee this month. So how do you kind of look at that to make sure it makes sense? I guess for
Yeah,
everybody.
yeah, it's looked at on a monthly basis. So,
Okay.
you may make January, February, March, you may be successful. You, as a team and in conjunction with your owner, may agree that you need to spend more in marketing because maybe you're behind. But that should come at the detriment of the management partner because that's, a change order, if you will, that needs to occur. So,
Yeah.
only because, you can miss a couple months and you can gain some months. But what you look at is, it's the cumulative fiscal year that you're really being objected to, right? And so you'll see that the overall formula is a real concept associated with what the actual management fee is, because it's the compounded effect over the course of the entire year versus just saying, hey, you're going to pay 7% regardless if I'm good or bad, right?
Yeah.
This way, it becomes an actual aggregate of the entire fiscal year.
Okay. And does that, I know I'm going way in depth on this pricing model,
Oh, no,
but
you're good.
just like,
You're good.
again, another thing, and just for the listeners, like these questions are just questions you can ask any property management company too, right? So
Hmm.
trying to lead by
Of course.
example with that too. But the other question I was going to ask is, does that, you throw out seven, I don't know if it is seven, but whatever it is, the number, does that vary based on how many units you are managing? Is there like a tiered sort of level system built into your pricing?
Yeah, and so in regards to the, obviously student housing, the
Hmm.
percentages are a little bit lower than multifamily, and then obviously single family rentals carry the highest management fee, obviously because it's just one unit or a duplex or whatever the case might be there. It really just depends on the asset class. It depends on the lift of the assignment as well. Dictates kind of that management fee, scale, if you will. But really, at the end of the day, multifamily is anywhere between 5 and 10%, and then
Okay.
student housing is closer to 3.5 to 4.5
Interesting.
percent.
I don't know anything about student housing, so I've got a lot of questions with that too. Might have to do another episode, but I
Yeah,
don't
no.
know. It seemed to me like, well, I don't know why that'd be lower. Maybe you can enlighten us with that.
So yeah, it's lower because you actually have more. You lease by the bed versus by the unit, so you have more opportunities for more revenue, which
Okay.
creates it creates an imbalance on what the management fee should be. If I'm charging the same as multifamily, it's actually like double impact because, for example, if you have a 5 bedroom house, right, and you're charging rent on each of those bedrooms, you're going to gain more revenue than if you were just charging one base rent for a 5 bedroom house, which could be, $3,000, $4,000 versus charging everyone in the house, you know, $1,500 or $1,200. Obviously that revenue is higher. So what
Okay.
you'd see on scale when you're talking about massive apartment communities, you see that the revenue is much higher on student housing managed assets than on multifamily. So
So that's more. It's more a rent by the room model.
correct,
Because
correct.
looking at multifamily properties, I've seen some that were marketed as student housing, but
Yeah,
they're still, you have your whole unit to yourself.
correct, correct. It's probably more like student competitive because it's adjacent to a university or a college and they're welcoming students. But when we're talking about purpose built student housing, that actually means you're leasing by the bedroom.
Mm-hmm.
And let's say Chris and I, me and you were roommates. We're in a 2 bedroom, 2 bath, right? You have your own bedroom and bathroom. I have my own. And you fail to pay your rent, or vice versa, I fail to pay my rent. Legally, my obligation has nothing to do with your obligation. And
Yeah.
that's purpose-built student housing, right? You can default and get evicted, and nothing would happen to me because we're on separate leases. That's the benefit, right?
Kind of
When
like
you're wanting to
pad
roommate
split,
match.
sort of.
Correct,
Something like that.
correct.
Okay.
Yeah.
Okay. So, I mean, in your bio, it kind of mentioned, student housing, multifamily, affordable housing. Maybe you can talk about all three of those. Where you're
Mhm.
most involved, what you like, what you don't. Just kind of give us a good overview of that. That'd be helpful.
Yeah, actually, affordable housing is more specialized, to tell you the truth. You actually work really closely with really government and local agencies, and there's a variety of different parameters and legalities associated with affordable housing. That's not the majority of our portfolio. It's a segment of our portfolio, but the majority of our portfolio is student housing and then multifamily. And it's really, we focus and concentrate on top 100 colleges and universities across the United States, and then all the real estate associated around that centralized area. So, like Johns Hopkins, Cornell, Drexel, University of Pennsylvania, those high end prestigious universities, we really concentrate around the investment thesis around that, top tier university. But, just like I said, we're West Coast to East Coast. So we're looking at San Diego State, University of Arizona, University of Kansas. We're in a variety of different states, not just the Ivy League, but, up and
Yeah.
coming and top tier universities, not necessarily enrollment driven, but obviously that helps. But we know
Yeah.
that these institutions are not going anywhere. They are kind of embedded into the society or the market that we're focused on. So,
Nice. Yeah, and I know. Well, you know, I obviously there's a lot of it's a lot of those schools. There's a lot of wealthy parents who are
of
funding
course,
the kids,
yeah.
so the money's there for sure. And then so it
Yep.
makes sense. And then I went to UCLA and then Stanford. I don't know about UCLA.
Oh, there you go.
I didn't do student housing there, but when I went to Stanford, I know they had a housing shortage because they were doing
Yeah.
everybody had subsidized housing because they didn't have any
Mhm.
student housing on campus. So like there were a few of my friends who were lucky enough to get something on campus, but most of us,
That's awesome.
yeah. And even with the subsidies, I was paying what you would think would be like normal rent, but it was like half of what normal rent was in that area because it was Palo
Yeah.
Alto, Menlo Park, which is, just really high end stuff. So
Yeah, California is already expensive, so then when you tack that on, it's nuts. So
yeah. But I guess do you work
that's
with the
awesome.
universities to get for subsidized housing and that kind of stuff? So you're kind of getting partial payment from them too? Is
No, not necessarily. There are opportunities to work with the university directly when you're managing university housing, but really at the end of the day, we're working with the university in regards to like resident experience and being able to, you know, work with the university to bring over university resources to the off-campus apartments, right? Whether it be health and wellness, public safety, and a variety of different services that the university offers. We want to make that a seamless opportunity for off-campus housing as well. So,
okay. And then when you're doing student housing, is the big fear factor to me would be like, high vacancy and turnover. I mean,
mhm.
they're only there for a couple of years and then they leave. And I don't know how well they take care of the units. That probably goes back to how you're managing the units and how you're taking
Exactly.
care of them. But just seems like the bulk of my expenses come with turnover, and vacancies. So to me, I'm like, if you can
Sure.
minimize that. So I don't know if you can talk to that too.
Yeah, I mean, it really alludes to the first thing that I said. The more you take care of your residents, the more apt that they are willing to stay with you long term, right? Especially in multifamily. I mean, you see that the average renter tends to be like 5 years plus in multifamily. If there's not disruption within their own life about work or, having to move to a different city or anything like that. I
Yeah.
mean, why would you want to move year after year as a renter if you love where you live, right? In student housing, it's a little bit different. They do retain year over year, but it's probably less likely as they work through different, you know, work study items. They study abroad. They may be graduating. So there are a variety of different implications
Yeah.
there. But what I would say is it's a steady flow, right? If freshmen live on campus as a requirement, for example, the first year, then you can almost guarantee that they're wanting to move off campus that second year, and that becomes its own cyclical cycle in regards to demand and what you're able to offer, especially if you are a sought after product in that market, right? People speak highly of your complex. It's definitely gonna get through the market. So we don't necessarily see vacancy. Obviously there may be, you always budget about 5% vacancy in your budgeting, but more or less, it's very few and far between that you see a lot of vacancy in student housing, as long as you're running it correctly and you have those parameters set in place. And then obviously in multifamily, you're turning every single month. Someone's moving out based on their lease term and lease cycle, but anything you can do to kind of prolong their stay will be super beneficial to your bottom line.
What about for the student housing? What about summers? Kids who go back home for the summer. I mean, do you do 9-month, 10-month leases or?
There are some assets that offer 10-month, but they carry a higher premium. It's almost like a
Oh, okay.
12-month term at a 10-month
Oh,
price.
okay.
So you're not really losing any revenue there.
Got
And then obviously returning all the units that people have vacated in a very, very short cycle, if you will, if you're familiar with that. So we turn approximately half of the property within, 3 weeks, call it, which is an insane timeline. A very condensed timeline, if you
Yeah.
will. Painters, cleaners, and carpet cleaners are just or in and out of all these units
Yeah.
simultaneously. So
Yeah. I mean, you're expecting it, right? You know it's
yeah,
coming. So,
exactly. Exactly.
plan.
And to your point earlier, we've inspected the units multiple times prior to them moving out. We know what we're about to walk into. Nothing is a surprise, so that we're able to circumvent any of those big ticket items, whether it be like drywall or there's a leak or, carpet replacement. We already know that those things are going to need to occur. And so we plan and then we execute come the August timeframe.
Okay. Now, if any, well, a big question my listeners have a lot is they're struggling finding the deals. And I don't know
Correct.
if, and if this isn't your area, that's fine. But there's some property managers will be a good lead source for that too.
Of course.
Do you guys have brokers on your team? Do you guys help other people find these type of products, knowing that you would then manage it for them?
Sure. We have relationships with hundreds of brokers across the United States. We work with a lot of the big firms as well, like Brocadia, CBRE, Northmark, and a variety of smaller brokerage sites like GREA and a variety of different brokers across the United States. So not necessarily having a big broker is a good thing versus having, an off-market deal is
Yeah.
sometimes more
Yeah.
beneficial than a deal that's marketed to,
Absolutely.
everyone, right? And so, yeah, what we do from that relationship standpoint is that we can underwrite the operations piece and the revenue piece to kind of show you why this deal makes sense. And then you would incorporate your financial underwriting in regards to your equity or your investors
Yeah.
to kind of show them, hey, this is what we can do with the deal under, HH Redstone's leadership. This is what we think we can, get the NOI to, or this is the investment thesis associated with this asset. So in regards to finding deals, right, I said we use brokers, but we have a variety of different data sets that allow us to see when loans are coming up for maturity as well. And so what's that mean? That the loan is coming up for maturity? It either means that the current owner of the asset either needs to refinance the loan or they need to sell it. So it gives you a great opportunity to come in and, maybe like 12 months prior to their loan maturing, maybe offer them an off market deal to purchase their asset. And at that time, you have no competition,
Yeah.
right? No one else is
Cold
speaking
outreach.
to it, right? Yeah. Oh, I mean, strategic outreach,
Oh
right?
yeah, yeah, for sure.
maybe you visit their property, maybe you take a couple notes of what's going on, and then you reach out and say, hey, I was in the market, I was able to visit your property, I was really impressed on, how it looks. Would you be willing to
Yeah.
sell it? I understand your loan may be coming due in the next year. I know you
Yeah, because
create a
that's huge. That's a
relationship like
huge opportunity right now, right? Are the loans that are coming
that.
due?
Absolutely.
They got really low interest rates, and
Yeah, they don't want to refinance.
yeah, exactly,
They'd
exactly.
rather like 1031 it and go find another deal, or
Yeah,
and then obviously we can work with that new owner as well to
which
finding another deal that
hopefully we're in the opposite situation. Hopefully rates go down, right? Hopefully we're buying now at what we're saying is a high
God
rate.
willing.
I mean, it's
Well,
all
yeah.
relative, but
Yeah,
yeah,
yeah.
yeah.
So that's all.
All right.
It's all part of the strategy and all part of the demand metrics into finding the right deal. I would argue that better to be patient than to buy a deal incorrectly,
Yeah.
because then it's just going to bleed money, and you're just going to be basically burning money monthly versus cash flowing at the end of the day. So,
Nice. All right, last I got one more question for you and then
sure.
we'll kind of wrap things up. And so how should investors now, these are the markets I'm in. If you don't work in these markets just globally where you are, but how should investors in markets like Dallas Fort Worth and Milwaukee be adapting their strategies today to prepare for where operations in the markets are heading in the future, in the next 12 to 24 months?
Yeah, I mean, I would start really looking at what your property management partner is delivering to you on a monthly basis, from a reporting aspect versus, it just be a bunch of numbers in a reporting structure. Actually understand what is driving those numbers. It will give you better insight on how the market is performing as a whole. And then also make sure that you are conducting market surveys specifically in those markets. I'm very familiar with both of those markets. I've actually owned and managed assets in Arlington, Texas, which is
Nice. Yep.
equidistant between Dallas Fort Worth. And so, that's a niche within even the Metroplex. And all of those aspects operate differently. Dallas operates differently than Arlington and Fort Worth, and then even the surrounding rural area associated with Fort Worth operates differently on the demand structure. And so, what I would argue to say is that you need to understand the market dynamics specifically for your zip code, if you will, right? Understand what is the average rent going for, and how do you match up against your competitors. And if how you match up in your competitors is not pleasing to you, then make sure that you're pivoting your asset and your performance so that it is operating at its fullest potential.
Love it. Love it. Awesome,
Yeah.
Teddy. Well, before we wrap, and this will be in the show notes, but just what's the best way people can find you, connect with you?
Yeah, you can reach out to me directly via email, Teddy at hhredstone.com. And I'm also very active on LinkedIn. Feel free to reach out anytime.
Awesome. All right. Thanks for all the valuable
All
insights,
right.
Teddy. Appreciate your
Of
time today.
course. Of course. Have a
Take
great
care.
rest of the day.
Thank you. Thanks for tuning in to this episode of the Cash Flow Authority podcast. We hope the insights shared today help you take the next step toward optimizing your finances and building sustainable wealth. If you enjoyed this conversation, please take a moment to subscribe on your favorite podcast platform and leave us a review. It helps other entrepreneurs and investors discover the show. And don't forget to catch the next episode for more insights. Until then, keep mastering your cash flow.